Everyone. Today, let's talk about that jobs report. In case you didn't notice, the jobs report came out this morning, and again, payroll continues to stay strong and jobs continue to be open. This causes the Fed to continue to be hawkish and continue to raise rates, which is bad for stocks. Then we'll look at how this report affected the markets. Then we'll talk about my performance over the last week and how I'm positioned going into the next week. Definitely like and subscribe if you like this kind of content. Make sure you hit the bell so you don't miss out on any future episodes. Really helps out the channel and hopefully you make some money off of some of this information. Welcome to the Portfolio Bulletin. Let's get started. So unemployment data came out and markets fell immediately. So payroll rose by 263,000, showing that the job market is still pretty strong. It was slightly below estimates at 275,000, but it was still strong enough to make sure that all of the major indices went down and that the Fed can remain hawkish on rates. Unemployment continues to go down to 3.5% versus the 3.7% expected. So we beat the unemployment rate expectations, again showing that the economy is still quite strong. You can see that September's job growth was a little bit of a decline from August and July, where July was at 537,000, August at 315, and September at 263. They say stock futures went down immediately once it was released, and they say that this puts the nail in the coffin for another 75 basis points in November from the Fed. They say wage earnings went up 0.3% this month, in line with estimates, meaning that overall wages are up 5% from a year ago. They go further to say that a drop of 25,000 government jobs was actually a big contributor in the missing expectations, showing that the public economy is actually stronger than expectations, despite things like the Russia-Ukraine war and potential black swan events in the market. Fed officials like Jerome Powell continue to say that there might be some pain in the economy as they continue to raise rates, and they say the unemployment rate could rise to 4.4% before dipping back down to 4% overall. Moving over to the NASDAQ charts, you can see as soon as the report came out, the market started dropping right off a cliff here on the 5-minute chart, and then it continued down all day, flatlining right around 269, just below that 270 level. So what does this mean on the daily chart? You can see we are right at the June lows and testing the same level that we started on 3 October, basically canceling out this little island of trading days that we had here, gapping down into that range. We still have decent support at 265, goes all the way back to September of 2020, the highs here in July of 2020. So we have decent support at 265. We'll see if that continues to hold into the next week, but right now that is the level of support that I'm expecting to hold as I trade the NASDAQ. Moving over to the Russell here on the 4-hour chart, you can see it's a little bit more bullish. We're not at the lows that we had previously, or the lows that we had here in June. We've retested those lows here in September, and right now we're sitting a little bit higher than the NASDAQ, so the Russell seems a little bit stronger, and it didn't fall quite at the NASDAQ, and we have this weird level of support potentially here, just a point or two lower. But it seems possible that we could get a bounce off this and maybe continue higher, and that's something that I'm definitely looking for on Monday. Let's take a quick look at AMD here. This is a stock that's been on a huge run and then got destroyed pretty dramatically. You can see the highs here at 157.50, maybe a little bit higher, 163.50. Currently, the stock is at $58. So sitting back here in the June highs of 2020, before we had that big breakout, which led to that massive run. There's certainly potential we could see it hold in this vicinity. It did get a downgrade, and you can see that big move here. It was falling into the end of the day on Thursday and then gapped down and continued down all day. You can see even from the close on Thursday to today, it's around 13.5 or 14%. So really strong down day. Definitely keep this one in mind though. This is still a good company and we're getting into prices that are a little bit cheaper and maybe worth buying here on AMD. Another company that's doing very well, this is CrowdStrike. Had a little bit of a down day today, but not nearly as bad as AMD or any of the major indices. You can see we hit 181, 182 here on Thursday before closing basically flat. Then we got all the way down to 171, right on that support at the 9 EMA. If we can break back above this resistance, I think we can get a nice little rally. It seems like we have a little bit of a channel going on. You can see the resistance / support we had going on here, and then support back down here. So you could try to be patient, see if we retest these lows at 163, 164. Or my expectation is that we're going to bounce off this 9 EMA. We're going to get back above here, and then we could see a nice little up move in CrowdStrike. And last up for individual stocks that continue to do well, this is Lululemon. It's had a little bit of a drop here from 350 all the way down to 279, 280 before rallying back up to 316, but we're currently just below $300. 397.70 was the close, but right on this support level, and you can see we're still off of the May lows and the July lows, so fading higher lows for sure. And it seems like this support is going to hold, and we could get a nice little rally back up into the 340 range, or at least 325, where there is some resistance. Moving over to XOP, you can see this is still a pretty strong chart. We did have that big breakdown. We've bottomed, created a little bit higher low, and then rallied from there. I would expect to see at least a retest maybe in the 135 range, maybe sell puts in here. We have a lot of moving averages converging here, and it looks a little extended. We have that spinning top here at the upside. So maybe another down day or two, but expect support around 135 to 137. Finishing up with ETFs here, we'll look at TLT. You can see we're still in that massive move down, pretty extended, pretty oversold. But of course, the jobs report did not help bond prices. And you can see we're still historically quite cheap, going back to prices from October of 2010. As I mentioned in previous videos, I think bonds are getting pretty cheap, and I have started buying some bonds in my longer term accounts. I don't know if it's time to trade it quite yet, but in terms of an entry point for long-term investments, this seems like a pretty good one. Moving over to SPX divided by the M2 money supply. This is not a very common chart and not one that I look at all of the time, but it's definitely good to know where you are generally in relation to how much money is in the S&P 500. And it gives you an idea of overall pricing compared to where it is normally in history. So you can see we have a pretty solid resistance here at 0.22. We did get above that here for the dot-com bubble, but it didn't last very long. And after that, we broke down pretty significantly. Decent support here at 0.14. This is when we had that little bit of a bump after the dot-com bubble and before the 2008 crisis. This is the monthly chart, by the way. And then we have the 2008 crisis, where the stock market was obviously historically very cheap and a good buying opportunity, similarly to what we had during the high inflation in the 70s and 80s. That was the only time that it was cheaper than the 2008 crisis in terms of the S&P 500 versus the M2 money supply. Before that, you can see we were right in that range, 0.14 to 0.22 generally. It seems like we stay in that range unless there's a major crisis, and that's where we are right now. So we hit that 0.22, and then you can see we've come down to 0.17. So we're not quite at that 0.14 support. You can maybe argue that this support level could hold. We could get some kind of double top here on the monthly chart. That would be great. But keep an eye on where we're at. If we get down to this 0.14 and we don't have a major war between NATO and Russia or another great financial crisis, I would expect the 0.14 to hold. And we could see another rally similar to what we saw from 2013 back to 2020. Next up, looking at the NASDAQ divided by the S&P 500, you can see we're still on that downtrend. The S&Ps are outperforming the NASDAQ. This doesn't matter to me that much as a short-term trader on the NASDAQ, but it is good to know that you should expect the NASDAQ to underperform the S&Ps at least over the short term. We had this big historic run where the NASDAQ performed dramatically. We had a decent topping formation, and then we've been moving down. We have some support down here at 299, maybe a little lower down here at 295, but right now this definitely looks bearish for the NASDAQ versus the S&P 500. Lastly, here we have the VIX. You can see we're definitely in this bullish structure. We did have that retest and move back down to this lower level where we found support, and it seems like we're moving back up at least a little bit. I would expect another move up a little bit on Monday. It could certainly go up to this resistance point or that higher level of resistance, but pending another black swan style event, I don't suspect we're going to get that big break level, and we could see another move down, which would allow the markets to go up. Finishing up with my account progress, at the end of last week, I was at 82,900 and some change, so up a little bit to $84,642. So about a $1,500 gain on the week, pretty good, considering that the week was down overall, at least for the NASDAQ, which is the main thing that I trade. And you can see here my current positions for my Roth. I have a position in IWM. I will get assigned here at 169. I took that position for a 56-cent credit, and you can see the stock is currently at 168.61, maybe a few cents lower in after hours trading. So basically right at my break even, if not a little bit above my break even. But I already sold the call here for $1.19. So my net profit on this position is capped at $1.75 per share, so $175. And we'll see how that turns out on Monday. Moving over here to the NASDAQ, you can see I sold a 270 put for 64 cents. So I did lose a little bit of money here, 47 cents, but I already sold the 270 calls for Monday for $1.77. So if the stock stays here, I'll get a profit. If the stock rallies, I'll get more of a profit. And then I sold 2 puts for Monday, trying to get into those positions. 3 contracts of NASDAQ is pretty much where I cap out, so I'm not looking to take any new positions for Monday, but I still will be on the lookout for a position for Wednesday. If we get a nice little sell-off, I will roll out one of these puts, probably get a sign on the other put, and then sell calls against that one as well, and roll down these 270 calls. Overall, not too long. You can see my beta weighted delta is 100 shares here, so not too long, but of course that will go up as I get assigned on those 2 contracts. Comment down below what you think of the jobs report, or any of the markets that I mentioned, or any markets that I should be talking about. Definitely like and subscribe if you got any value out of this video, and hit the bell so you don't miss out on any future content. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to today's jelly. Today's jelly is Nick Kroll in his new stand-up special on Netflix. It was absolutely hilarious, and he is a very talented comedian, surprisingly vulnerable for a comic like himself. And then they also mentioned here that Big Mouth is coming back for a season 6. So he's really crushing it right now, and I like all of his content. Big Mouth is hilarious, and his stand-up special was also very good. Comment down below if you've watched his special or what you think of Nick Kroll. And with that, good luck in your trading, and have a great day.